you or your parents or whomever that has investment portfolios, just take a look, see how much income it generates, and ask yourself, would it be better if I had more income? Then you take steps from there. You either do it yourself, you figure out how, or you get your financial advisor to commit to making you more income.
Step into the world of success with your brand amplified, the ultimate podcast designed to unravel the intricacies of thriving businesses. I'm your host, Annika Jackson, and I'm on a mission to uncover the stories, strategies, and secrets that have propelled entrepreneurs and business leaders to success. Steve Selengut and I were just saying that this interview's been a long time in coming. And Steve, we're nearing the end of 2024, getting closer to the end of Q3 and into that time when people really are planning their what next. And you have built a career on helping people think beyond the past and the present and into their futures and to have the income that we all need. Because I think sometimes we get caught up in the day-to-day minutia and forget. So I'm really excited to have you here to share your secrets, your retirement money secrets, as your book, for anybody who's watching, it's so proudly displayed behind you, and learn more about your journey and career and why this is such a passion area for you.
It's been a long journey. I started when I was 25.
Wow.
I started investing when I was 25, and I got interested in income right away. For some reason, I wasn't interested in investing in anything that didn't pay me income, and that included the stock market. So if you think about it, it saved my financial life around the dot-com era because the crash there was just pretty much in the tech sector that didn't pay any dividends. So I didn't have any of that stuff. It kept me away from mutual funds because they don't pay much income. And I always felt that they were victims of whatever the mob wanted. If people panicked, they had to sell stuff.
Yeah.
If people panic, I want to buy it. It's like the call to the mall when you're shopping. When somebody says something's on sale, you don't run away. Oh no, if the price is too low, you say, I'm going to go see if I can find something that's worth, that's a bargain at that price. And that's the way I always looked at the stock market. I was never afraid of the down markets. And I always took advantage. I always sold things on the up markets. And I think I got that from my dad's background he developed and sold real estate. Mm-hmm. And he had rental properties for the income, and he sold his customers. He took back mortgages. So he had that stream of income. He had a part of his business was insurance. So he insured the homes and their cars and stuff like that. So he had all these different ways that the income was always coming in. So it didn't matter to him what property values were, because if he couldn't sell anything this month, it's no big deal. I'm still getting my income. Okay. So I approached investing the same way.
Yeah. And that's probably a little different than most people think about investing. I know my daughter is 16. She has money in the stock market. She knows it's a long game, but she does check it every day to see what's going on. And so it's a great lesson for her. But I'm really intrigued by this idea of looking at everything as income, because also a lot of people who listen to the podcast, and actually myself, I'm an entrepreneur. I'm a multiple time entrepreneur. I'm always trying different things. I have way too many ideas. Some are successful, some are not. But I also understand the need to make sure that I have, steady income coming in so that I can still test and iterate and create new things, but I'm not dependent on that income for the current time or the future.
Exactly. That's the idea. I set up a way of managing money for my clients. And I managed as much as 110 million in capital. That's how much it was when I sold the business in May of 23, just over a year ago. And these people were all over the country, a couple foreigners, but not many of those. And the thing I used to tell them was, if you spend less than 70% of the income that I'm making for you, I'll be able to continue to grow that income. and I'll be able to grow it whether the market's up or down or sideways or interest rates are crashing or going sky high. It won't matter because of the things that I invest in and the way they pay dividends
Yeah.
and distributions. It's a different approach. The focus is different. All Wall Street companies and most investment advisors are focused on growing your income, not your growing your market value
Right.
and creating what they call returns.
Yeah.
And what a return means to them is that, last year your portfolio was worth $100,000 and this year it's worth $115,000. But in most of those situations, the income being produced wasn't much in the first place,
Mm-hmm.
and it didn't change any just because the market value went up. And
Mm-hmm.
then when COVID comes along and the market value goes all the way back down and further, it's still not producing any income, and their returns are now negative. On the other hand, my way of looking at it is when the market value of my securities go up, I set a target. If it's up a certain amount, I sell it. And that means I've actually created extra. I have created additional capital in the form of the dollars of profit. And I reinvest it, and it makes me able to earn even more income. So if my market value goes up to $120,000, I've probably capitalized that profit. And now I have $120,000 producing income, not still 100.
Mm-hmm.
So that's the difference. That's the difference.
Yeah.
And if you do that, particularly as you approach retirement, or like you, if you're ready to go into some other career, you want to start a new business like I did when I was 25, you need that income to get you by while you develop this new business. I mean, I started this with two people, my dentist and a guy who ran a restaurant out in Long Island, who each gave me about $20,000 to manage for them. And that's where it all started. And I had my own money and this little bit of money of theirs, and I started to grow a business. So I had already developed my own spreadsheets of how my portfolio had grown for just me in the years before. So I could use that as a tool. But I didn't have any experience. I didn't have any track record of anybody else's money. So I had getting the next 3 clients was not that easy. They weren't, you can't just go to your parents. My father wouldn't go near the stock market, so he wasn't going to help me. So, you just had to do it and grow it. And then you could show more and more examples how the income grows and the capital grows regardless to what's going on in the market. And after a while, it just took off. A couple radio shows and
Oh, nice.
things like that, and it got started.
Well, that's what I was going to ask you because you started your business pre-internet in
Right.
days you don't have digital advertising. So was it primarily word of mouth? People were really happy with
Were the
behaviors?
customers? Yeah, certainly. My dentist, dentists are, right? So if he's happy with his investments and he's got somebody with his hands in his mouth they can't reply or anything, he's going to be talking at you. So he was telling people about Steve and, how he's managing money because we had mutual friends and acquaintances and stuff like that. And the guy out in Long Island, he wasn't a whole lot of help with that because he was really not really that conversant in English.
Okay.
He was Italian restaurant, great Italian food, great Italian guy, and real fun to be with, but understanding what he was saying a lot of time was difficult. And all he knew was that Steve was taking care of this, and there were really no dialogue or anything. So, but anyway, it was interesting to say the least to get it up and running. But the only reason I was able to, because I was still making 5 times what I had been making when I was employed just for running my own portfolio. That's where people have to get themselves, particularly in their 50s and 60s. They got to start thinking, what is going on with this portfolio of mine? It's big, but it's not producing any income. And most people don't even look at that. And if there's any message they should be getting from this conversation is look and see how much income you're actually making.
Yeah.
Think about how you certainly can make more.
What are some of the tools that you talk about and the methods that you've honed that you're sharing in your book, Retirement Money Secrets?
The book really has two or three really strong messages. The first one is risk minimization
Hmm.
and how to determine if what you have or what your advisor has for you is risky in any way. And there are four really tests of that. And then we talk about appreciation of the fact that everything is cyclical in the financial markets. The market goes up and down. It's never going to be straight up and it's never going to be straight down. Or we certainly hope so. But, and the same with interest rates. You really, they have a longer cycle
Mhm.
and they don't move as quickly, but they're still cyclical, up and down, up and down. We're in people, younger people today are thinking of this 5% environment that we're in as high interest rates. When I was growing up, 5% was low interest rates. You know, it never was below five. And then after the financial crisis, of course, they created this environment where it's near zero, which was really not good for older people because
Mhm.
they couldn't, savings accounts weren't paying anything anymore. So
Oh,
they were forced to go into the stock market to get, quote, returns. So they had to go into a much riskier environment to get any money at all, any spending money or growth in their value to spend. So interest rates going down isn't good for everybody and certainly not for long stretches like this last time. So that's one. Then the other major thing other than the risk is to the focus. And that's a mindset thing of changing the person's focus from market value growth to income production. You
yeah.
can't, the tagline on the top of the book is market value fuels the ego, income fuels the yacht, which is telling people, doesn't matter how much money your bottom line says on your statement, you can't go to the grocery store and spend it, much less go on a vacation, you know? But if you have that income number big enough to pay for that vacation, I mean, you can write a check without selling any of your securities
Yeah.
to do that. So it's tough to get used to, but that's what I told my clients I was going to do. I was going to take their profits. I was going to reinvest. I was going to grow their income. That's it. If you don't want that, you have to find somebody else.
Yeah. Well, you hit on a few points that were questions that I had teed up. And one was about high interest rates versus lower interest rates and why each one can be a positive versus a negative.
Yeah, for an income investor, let's say, and this is it's basic stuff for somebody who's taking any economics or business courses in college, but certainly not for anybody who's still in high school or a high school grad and hasn't had that type of exposure because our education system doesn't go teach you anything about this stuff. I don't have any conspiracy ideas about why, but it just doesn't happen. So if you think of what a bond is, a bond, a government bond, a municipal bond, or a corporate bond is an income. People are loaning money to the entity, and the entity is paying them interest. And it's usually paid every 6 months. You get a check. In the old days, you used to clip a coupon and take it to the bank. But now you get a check in the mail or deposited directly to your account of the interest. Now, if interest rates go up and you wanted to sell that bond, the guy who buys it from you is entitled to the higher interest rate environment. In order for him to get it a higher interest rate, you have to sell him your bond at a discount, right? If it's a $10,000 bond and interest rates have gone up a full percentage point, the value of your bond is going to go down so when someone buys it, it equals current interest rates. So it's always for 30 years, it'll go up and down, up and down. It's almost never selling at, if it's a $10,000 bond, exactly $10,000. It varies. Sometimes it's at a premium, higher price, or a discount, lower price. But one thing doesn't change: the income it produces. So it doesn't matter. The other thing that doesn't change is the amount that you get when it matures. You get 10,000 bucks back, you know? But very few people, when it goes up to a premium because interest rates are down, will sell it and take the profit. Just hold on to it. I sell it. And when interest rates go up, I'll try to find similarly bonds that are pay that I can buy at a discount. So when they mature, I'll have that profit.
Okay.
So that's the nature of the income focused market. So when interest rates go up, you have the same income coming in, and now you can take that income and buy higher yielding securities, growing your income. When interest rates go down, the price of your securities goes up, you can sell your securities at a higher price, take the profit, and buy more securities. So either way, when you're an income focused investor, you can take advantage of the cycle and you can buy packages of stocks as well. Just like you can have mutual funds that are hundreds of different stocks and ETFs that contain stocks. They don't typically they don't pay a lot of income. Some of them do, not many. The average is below 3% for either of those. There's another type of fund that's actually older than either of those. They were developed in the early 1800s, about 30 years before mutual funds and 100 years before ETFs. And it's called closed-end funds, which are really trusts. And you may be familiar with trusts. It's something you can set money aside in a trust for your kids or something like that, or your parents did for you, and you get the income from it, and the trust doesn't pay taxes. You pay the taxes. It's the same thing with these funds. They're trusts. So they'll go out and buy a gazillion dollars worth of equities, stock market stuff, or a gazillion dollars of bonds and notes and mortgages. And then they have to give the share owners who own the trust, that's what the stock you buy is, ownership of the trust, they have to pay you 95% of the income that comes in. Unlike stocks like Amazon or Microsoft or even Exxon, they pay whatever they choose to pay for the dividend. Some of them raise it, but some of them pay nothing. Like, Microsoft didn't pay anything until it was in existence for, 30 years. I don't know how long before it ever paid one. So that's the distinction. What I invest in these things that are really income purpose, and they're not making any attempt to grow their market value. Well, you can't. It's pretty difficult to do that when you have to give away 95% of your earnings. So they don't focus on that, the ego part of it. They focus on the income part. So that's the type of investing I do. So
how easy is it for just somebody like myself or somebody who's listening to do this independently of an advisor?
It's about as easy as you just made it sound. There's 2 or 3 different websites that talk about closed-end funds. There are over 400 of them. There are in the stock areas, every possible sector you can imagine to buy stocks in. And it's the very same stocks you would go out and buy individually. They're just in this package. The same companies, the same everything. They're just focused on the income and the trading of them, and they'll sell covered calls and other types of ways to make more income on them. So, so anybody, you can get Berkshire Hathaway, a couple $1,000 stock, right, in one of these packages, and it's $15 a share.
Oh.
You're not buying Berkshire Hathaway, but Berkshire Hathaway's in that fund. You can buy anything that's hot, anything that's very popular. I mean, these guys are professional managers running these things, and they know how to make money on them, and they also know how to take their profits. They don't fall in love with securities like the normal guy does.
Yeah.
So anybody can go. You can go out there and let's say this is your first. How much can you put into an IRA these days? When I started, you only could add $1,500 a year.
Oh my God.
It's probably $7,000 or $8,000 now.
I'd have to look it up.
So would I. But let's say now you have $7,000. You could, and that's your first $7,000 that you've ever invested. You could buy 5 of these closed-end funds and pretty much own every stock that's traded on the New York Stock Exchange and the NASDAQ, and if there are any other exchanges, them too, and have, you know, 10 different securities, 10 different diversified portfolios. You could make one of them AI because that's where everybody thinks all the money is, and it probably is right now. So you could do that and you wouldn't be taking nearly as much risk as trying to buy the stock, the next Microsoft or the next Nvidia. Well, I just saw an ad somewhere today where somebody is posing the question, is such and such now a better buy than Nvidia? And so people are going to run after that one now. So yeah, so you can do it. It's easy. You can study them at the Closed End Fund Connect is the one I use for all my research. I've narrowed down the 400 or more that are available down to around 250 that I use in my portfolio and that I suggest that meet all my quality, diversification, income, volatility. Volatility for me is a good thing. How that people get all excited about it?
Mm-hmm.
It's a good thing for me because I see that I have all these opportunities to buy and sell. See, there's two basic, we talked about my dad's business and he had like three different streams of income. In the stock market, there's two distinct streams of income. The income that's produced by the distributions that these things pay us, dividends, interest, and stuff like that. And the other stream of income is the profits that we are smart enough to take at a specific target, depending on where we are in the market cycle. When we're very, very high in the market cycle, you can make a target of, and these things I use 5 or 6% as a target where I'm going to take a profit. If we're in very, very low market, I sometimes would take any profit at all because I know I can reinvest that at a higher yield than I could have before. So it's really interesting. It's different. I feel it's safer. I never fall in love with a particular one, even though it goes up. I mean, over the years, you'll know that you'll think from your experience that some of them are faster to turn over than others. But you literally can make a lot of money with a very safe environment. In 2021, the last major rally we had when interest rates were low and the stock market was high and everything was up a mile, our book of business, it ended at 110 million, but it only started at about 97 the year before. That's how good 2021 was. And that's just a market value. In income, we had, it's 7%, so it's still great, but on 110 million, that's like $7 million. We added in profits the same amount of money. That doesn't happen every time. I haven't done that this year, for example, for myself. But that's the type of possibilities there are in a really strong stock market, because that pushes everything up. Because on the income side of the equation, particularly with interest rates down, a lot of the preferred stocks and convertible bonds that are in that type of income focused, they go up because they're convertible into stocks. So you're getting at both worlds. Depending how old you are, the average person in up to his 50s should still have probably at least 60% of his stuff coming from the stock market and 40%. And then as you get older and older, that flip-flops, to be like mine right now. I'm 65% in income securities and only 35% in the stock market.
Yeah. You're answering so many of my questions, but one thing I wanted to ask is, what's the minimum amount somebody can invest in one of these? For instance, I'll be very candid. I'm getting my MBA. I teach part-time at university. When I went through my divorce a few years ago, I ended up with nothing. So,
That's
my
unusual.
financial situation is really minimal, but it's something obviously I'm very interested in, engaged in, is thinking.
Well, I'll
When can
give
I
you,
start and what's going to be the best income producer for me for the future?
well, I'll give you an example. Here's a closed-end fund by BlackRock. You've
Mhm.
heard of the name BlackRock. It's one of the biggest investment managers in the world.
Mhm.
They have, they actually have almost, they own maybe 50% of all the municipal bond closed-end funds there are. But they're heavy into the equity ones and the income ones. But here's one that they're talking about. Okay, BlackRock resources or in commodities, which is kind of more uh, a little more speculative than the normal one would be, but the track record is good. It's only $9.33 a share, and it's yielding over 6%, 6.5%. But at $9 a share, you could buy 200 shares and still not have $2,000 invested in this thing. So if you have a small portfolio, even a $30,000 portfolio, that's not a big risk. And then let's look at I'm looking at for names that you'll know. You've heard of Nuveen,
Mhm.
and this one is a Nuveen real estate income. So it's investing in real estate, in properties, rental properties, or companies that are doing that, stocks that are doing that. Because this is I'm looking at my equity sheet here. This one's less than $8 a share, and it's yielding almost 9%.
Wow.
It's been around for 23 years, and it has 85 different companies inside. So let's say you want to get into here's one that's a Japan equity fund, you know. So it's got 70 different companies in it. It's only $6 a share, yielding 8%. It's been around since the 1990s.
Wow.
If you want to get, diversified. So I mean, I'm looking at sheets that have 100 different equity funds on it. The average cost is only $14. The average yield is over 9%. And the average fund owns 251 different stocks and has been around since 2002.
Yeah.
So it's not, so I'm getting at is you can, with a limited amount of money invested in a variety, a diversified group of diversified portfolios, you can have a presence in the stock market and the bond market. The bond market is very similar without putting a lot of money into any one and taking on a whole lot of risk. I mean, I've checked these for, how many things are inside, how long they've been paying their distribution. You can tell by the names. I mean, you got Pinco and Nuveen on here and Eaton Vance, Franklin, and Franklin Templeton as well. Gabelli, you've heard of. There's just all the big operators do these, but they don't advertise them.
It's fascinating. You're really sharing some secrets here that I think anybody listening, whether it is one of my students or it's somebody who's at the end of their career, this is achievable.
Right.
Yeah.
And your students are going to make sure their parents and grandparents are paying attention too.
Yeah. Yeah.
Because they're going to wind up with that.
Now, when it comes to the sales side of this, how much time would an individual have to spend? Because I imagine you put money in, but it has to be in for a certain amount of time to mature. But then how do you get
it could mature the next day.
Oh,
I mean, particularly in an equity fund like this, I'll find that sometimes you're really, really lucky and you'll have a spike in the market the next day and one of these things will go up 3 or 4% in one day. I mean, that's great. You can sell, but you don't have to. I set targets, and my main target now, we've been in an upward stock market, so I'm taking the top 4 profits every day.
wow.
And it's a large portfolio. So, so regardless, I'm taking the top 4 profits every day because I still have plenty to reinvest in. But everybody who goes into investing of any kind should always have a target profit in mind. I have the way I write about it in the book, I say, if it ever gets to 5%, take the profit no matter what. That's the upper limit. Because remember, you're dealing with mixed portfolios of many securities. It's not just one security that's spiking. It would have to be, many of them bringing the price up. So I say that. Now, like in 2021, you have to say, wait a minute, Steve, if I did every 5%, I'd be selling 30 or 40 different ones every day. So you have to recognize when the market is totally out of control like that, you have to ratchet your target up a little bit, you know. And so I reluctantly will ratchet it up to as much as 7%. But I've only had that once and I've been doing this for how many years? I've only in once had a situation where I had to ratchet my profit taking target up. How much time does it spend? Once you get yourself invested, I look at it twice a day, and I'm a pro, but I'm also very experienced. So I'm sure many of the people in my Facebook groups and stuff like that probably look at it 3 or 4 times, but you can look at it much less than that too. I mean, you're getting this base income right now. Interest rates are higher, but if you look at where they were 4 years ago, they're nowhere near, where the prices are nowhere near where they were 4 years ago. Unlike the stock market, which is almost at an all-time high. So, you know, there's always something to buy that you can get a good yield on, so it's kind of easy. So how often, you're getting a high rate of income, so the profit is kind of gravy.
Yeah.
So you set that target. You don't have to look at it every day. Look at it once a week. See what's going on. If you know that the market is going nuts, look at it more often. Take the profits more often. If everybody's crying about the market being down, you're getting your income. Look at it every now and then when you build up enough cash to buy something new at a lower price.
Fantastic.
There you go.
Steve, you have a great website name, theincomecoach.net. If somebody goes to your website, they'll find your book, both of your books, because this is your second book, right?
Yeah, I give away the first book.
Okay.
It's kind of more of a textbook,
Uh-huh.
whereas Retirement Money Secrets is more like a conversation.
Yeah. Thank you for sharing that. That really sets the stage. And on your website, so you can find your books, you can find tips from you. And then do you also work one-on-one with people?
Yeah, I coach people one-on-one in 3 different ways. One, if they say, I really want to get into this program and get this started, then we do a full coaching session, which means I look at their existing portfolios and I determine quality, diversification, income, profit-taking history, and I talk to them how they can improve it. And then I answer all the questions they could possibly have from the book or anywhere else. And then we start to zero in and focus on a plan, and we establish a plan to get from a normal market value focused portfolio to an income focused portfolio. And it usually is a matter of just a couple meetings, depending on the size and complexity and knowledge and how many times they read the book, how many times it'll take. But I also I'll look at the portfolios and I'll just tell you, if this is a problem, you have too much invested in this, or, you're not diversified enough overall, or you're not getting any income, or hey, this is wonderful. You're doing great. You have nothing to worry about. And then I have Q&A sessions. And I also sell the universes that I develop that I use for myself. So I'll have a spreadsheet looks like this, with a listing of all the companies, how long they've been around, what their yield is, what the dividend history over the past year. So like I'm comparing July 2023 to July of 24, and I keep sequentially each month it does that. So just to see the history and what's going on. And there's codes to tell you which ones have gone up, which ones have paid special distributions, and so on. So that's the other service I have.
Wonderful. Well, I want to leave some of your retirement money secrets for the audience to uncover via your website, your services, and your book. So I really want to thank you, Steve Selengut, author of Retirement Money Secrets, and theincomecoach.net is where you can find you. Do you have any final words of wisdom that you'd love to leave with our audience?
I think what it all boils down to is that you or your parents or whomever that has investment portfolios, just take a look. See how much income it generates, and ask yourself, would it be better if I had more income? Then you take steps from there. You either do it yourself, you figure out how, or you get your financial advisor to commit to making you more income. The rule of thumb for people when they get to retirement, and it's a good rule of thumb, the average person, average family will spend about 4% of their portfolio value a year. Okay. So in a rising market, it's not a big deal. You're basically taking it from profits, although most advisors will be selling the ones that are not profitable, not the ones that are profitable. But in the years like we've had the last 3 years, you're pulling that out of principle, basically, because you're not making, you have made an average of 4% over the last couple of years. So but the thing there are many ways to make more income than what they are making. They're not focusing on it. And if you tell them, look, if you don't make me at least 5% income, I'm going to fire you and find somebody else that will. They'll learn how to do that for you. They don't focus on income. They focus on working capital. They get their bosses, and the fees that you pay are based on market value, not on the income you produce for the clients.
Yeah.
So they're just not used to doing it that way.
Yeah. Well, I know from what you've shared with us about your success and growth strategies, sounds like a lot more people in the industry need to switch.
At least recognize, you can do it with, you can do it with just having dividend stocks. You can do it with ETFs that pay. I mean, I have a list of 20 ETFs that pay over an average over 10%. I think that's more speculative than the closed-end funds, but you can do it. You can use, there are real estate investment trusts out there, and they call business development groups that have paid significant income for years and years and years, but they're just roundly ignored by professionals.
Well, thank you so much for being here and sharing your expertise with us. I know I learned a lot. I took some notes, and I'm looking forward to diving into your further resources, and I know the audiences as well. So thank you again.
I hope they do.
Yeah, absolutely. And thank you to everybody who's watching or listening to this episode. I will be back again with another amazing guest in a couple of days. Thanks for listening or watching to this episode of Your Brand Amplified. Don't forget to leave us a rating or review on your favorite podcast listening platform. And if you want to learn more, check us out at yourbandamplified.com.